This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome back to a brand new episode of the Smart Property Investment Show. I'm Grace Ormsby, and you have to have been living under a rock if you had not seen that the Reserve Bank of Australia's board got together this week, made its latest decision on what is happening with the cash rate, and that was to hold it at 4.35%. So to talk through this, what it means, what the continued stability, I guess, at 4.35% does mean for the Australian property landscape, it's an absolute pleasure to be once again chatting with Dr. Diaswati, Mardiasmo. She is the chief economist at PRD, has her head in this kind of data every single day. Asti, welcome back to the show. Thank you so much for taking the time.
Hello. Thank you so much for having me. It's always a pleasure.
Asti, the RBA brought out that 4.35% rate this week. Was it what you expected?
Look, I will be honest with you that there was a little bit of a touch and go. And the only reason for that is because inflation rate did increase slightly in the past quarter. And we were always a little bit afraid that, if inflation rate goes up, then the cash rate might go up. Because one of the things that the RBA did say is that for them to do anything in relation to the cash rate, it's always going to be based on inflation rate and wage growth. So I think a lot of people were asking me going, inflation rate went up a little bit. Should I start to get worried? Are they going to actually increase the cash rate? And at the time, my thought was that no, they weren't going to, because it was only a very slight increase. And it does take more than just one increase, like one episode of increase, for example, for the RBA to then start increasing the cash rate. So it wasn't a surprise to keep it at that steady 4.35% for that particular reason, that it was only one episode of the inflation rate going up. And even then it was only very slightly. And second of all, it is also the cash rate position that a lot of reserve banks around the world is taking at the moment. So we're following pretty much what everyone else is doing, whether it's New Zealand, whether it's Canada, US, UK. They're also doing pretty much the same thing as what our RBA is doing.
What do you think will happen later in the year then? Because there has been talk that maybe this one would be a hold, but we could still see subsequent rate rises still in the picture before the end of 2024. I think a lot of people are probably just confused at this point in time, given there was so much talk that really, if we go all the way back to 2021, 2022, that we wouldn't see any rate rises until 2024, 2025. We saw consecutive rate rises, but then there's been talk that it would be dropping by the end of the year. Where are you sitting with what could actually happen next?
So it is quite confusing, actually. And I can definitely see how, this sort of stability that we're seeing right now is what I would call a cautious stability. And we're seeing that in our consumer sentiment. We're seeing that in the amount of people that are in the market and the fact that they are taking a little bit longer in their decision making to actually put in an offer or to actually put in the highest offer possible for, especially for units, for example. For houses, we're still seeing a much quicker turnaround time, but that's because, let's face it, there aren't that many new houses being built. Whereas with units, you have a little bit more choice. So we are definitely seeing that cautious buyer, that cautious sentiment on the ground. And that's because, like you said, people are unsure of where we're sitting or whether we're going to see an increase, a decrease in the next meeting, etc. So the good news is that along with the cash rate decision, the RBA also published their statement of monetary policy on the same day, which gives us a little bit more insight as to what they want to do, how they're seeing things, where they're taking us. And the latest policy cash rate expectation draft that they released, which is kind of interesting because the last one that they released back in February 2024, so not long ago, only went to 2025, whereas this one actually went to 2026 and beyond. So that actually gives us a little bit more insight as to where they're looking at taking the cash rate. And the pattern is that at the moment, it is still stable. There is a little bump up, like a little, very small bump uphill sort of thing before it starts to go back down again. And if I look at the graph, and if anyone is looking for that graph, if you go to the RBA's website, Statement of Monetary Policy for May 2024, the graph does show stability, a little bit of a bump up, and then starting to come back down again around the end of 2024, early 2025. So like I said, this particular graph actually gives us a little bit more clues, because the last one in February only went up to 2024, whereas this one goes all the way to 2026. And if we go to all the way to that 2025, 2026, the pattern in that graph is one that is going down. And that is not just for us. It's also for New Zealand. It's also for the UK. It's also for the US. So it seems like the whole world, so to speak, or all of the RBAs around the world are thinking along the same lines.
Okay. So what then, you've already alluded a little bit to what's happening in the property market at the moment. And obviously we are crystal ball gazing, so I'm going to give that disclaimer now. But what are you expecting? You are looking at property analysis all day, every day. What is the rest of the year going to look like when it does come to property? Because I feel like, there's places across the country that are dealing with undersupply. We've still got the rental crisis going on. There's so many big factors that are at play here that aren't just what the cash rate is doing.
Absolutely. And, a lot of people put great emphasis on the cash rate, and they're not wrong, because the cash rate does, give you, it does allow you to kind of look at, well, what is my borrowing power? And if my borrowing power goes down, then that means, I can only afford this type of property, or it's a certain amount or a certain less price. But that's not the only big factor that is playing in the property market right now. Demand and supply is very much so still in play. Supply in units, it's a bit better right now. There is definitely a lot more movement towards what many governments would say to be gentle density. And that is promoting, your 2, 3, 4 story sort of like apartments in suburb areas. So like in your inner ring or in your inner city sort of like suburbs. So we are seeing a little bit more supply, but again, it is in the unit section or in the unit sector, as opposed to the housing sector or the detached dwelling. So detached dwelling is still seeing a lot of interest. It's still seeing a lot of people wanting to buy as soon as they see the property or the house that fits the bill, everything that they need, they're onto it. But when it comes to units, we are starting to see a bit of a slowdown because of the amount of choice that is starting to become available. Many people have asked me, is now the time for me to get into the market? Should I wait until the cash rate go down? The answer to that is a lower cash rate does mean that you do have higher borrowing power, depending upon your bank, of course, because, many also don't know that banks don't always have to follow the cash rate. Some of them, even though the cash rate is currently stable, have decided to increase their variable interest rates, right? So it really depends on your bank about your borrowing capacity. But the one thing that I always say is that history has proven that when the cash rate goes down, demand goes up. Many, many more people want to get into the market because the cash rate is down. And our supply is not going up in the speed that we would like it to match any increase in demand because cash rate is going down. So, it's definitely almost a catch-22 where people are waiting so that they can borrow a little bit more. But then at the same time, knowing that demand is going to go up during that period and we don't have a lot of supply now. So some are caught in this whole, I've got to do it now before, the cash rate does get slashed, and a lot of people are starting to flood the market, especially if I'm looking at a specific type of property. But if I'm looking at a more generic property, so for example, 2-bedroom, 2-bathroom units anywhere in the city, then I can afford to wait just a little bit longer.
It's a good point to make. We're going to take a quick break there. Plenty more still to come from Dr. Diaswati. Mardiasmo, just after the break. See you very soon.
Are you looking to invest for a big return, but are unsure which suburb is up and coming and guaranteed to give you the most bang for your buck? Smart Property Investment and Pure Property Investment have unveiled the Fast 50 report for 2025, identifying the suburbs backed by research that are giving investors the highest returns. Don't make any investing decisions until you read the free report. Visit smartpropertyinvestment.com.au to download the report.
Hey everyone, welcome back to this episode of the Smart Property Investment Show. I am joined by the Chief Economist over at PRD. She's zooming in from Brisbane at the moment. That's where her office is. Dr. Diaswati, Mardiasmo, Asti. Before the break, we were talking about what is going on in the market and timing, buying, what people are thinking about when it comes to their lender, how much borrowing capacity they really do have. But one thing that's probably been less of a conversation more broadly, but is still very, very relevant at the moment, is this mortgage cliff that has been talked about for a long time now, but it probably has fallen off its own cliff in that people aren't talking about it anymore, despite the fact that it is actually still very much a thing that people are dealing with. I think you yourself have just come off your fixed rate at an interesting time in the market.
That is absolutely right. I came off my fixed rate in April, so not long ago, and I got my letter back in February saying, you're about to come off your fixed rate, which was 2.1, and you're about to enter a variable rate in mid-April, which is going to be 6.8. So I did the maths and I went, oh my goodness, where am I going to find an extra $900?
Wow.
And I was one of the lucky ones, and I've got my inverted commas because the mortgage on my property is quite low. So it's under 300K. If I had a mortgage of 500 or 600K, I'd be trying to find almost $2,000 to make my next payment, right? Now, it has become less in the media or less being talked about because the bulk of people who are, or I suppose who went off the cliff have already happened. So I'm kind of like the latecomer to the whole mortgage cliff thing, because I fixed my rate, 3 years ago, which meant that, I'm kind of that late bloomer in the whole mortgage cliff refinancing market. But then again, there's still about another 10-15% of mortgage loans that are about to come off the mortgage cliff anywhere between now and the end of this year. So there are still us late stragglers, I suppose, still opening up our mail. And, even though we know that it's coming, we know that it's going to happen, it is still a shock seeing from 2.1 to say 6.8 and then going, oh my goodness, that's going to be an extra, 800, 1,000, 2,000, depending on your loan, on your next payment. And so, of course, the first thing that I did was, I would not advise anyone to do this, is to Google refinancing low interest rate, which meant that straight away after I Googled that, my Facebook feed, my Instagram feed, my every social media feed is filled with mortgage brokerage or banks or any other lender type thing with their ad of, you can get lower interest with us or however many fix for this month, for that month. And also some offers of like, how would you like to pay off your mortgage in 10 years instead of 25 years? All of those sort of like ads started to pop up. And I got to tell you, I'm a chief economist in this field. And even for me, it was a bit of a minefield.
Which bodes less hope for the rest of us, Asti.
Because I sort of went, okay, where do I start? Like, yes, we always say talk to your bank first, right? And that's what I did. And so I got their best offer. And I looked at it and I went, that's not really good enough. Especially when I know that there are friends who are on like, 6.2, 6.1, and I know that there's, I think, some products right now that is like 5.9, 5.98. So just depending. So what I did was I reached out to mortgage brokers that has been recommended it to me. And me being the researcher that I am, Grace, I didn't just go to one mortgage broker. I went to 3 mortgage brokers and, had my calls with them, told them everything. But you know what? Apparently I was a dream client because I knew my numbers. I knew how much I had in my accounts. I knew how much assets, how much liabilities, I could answer their question. So I suppose anyone who's listening, if you are going to refinance, have a cheat sheet that's next to you before you call your mortgage broker with like how much loan you have, what your percentage in the loan is, how many more years, what your assets are, your liabilities. Even with your credit cards, always remember that it's the full amount of the credit card. So even if you only owe $5,000, if the credit limit is $40,000, then they'll take $40,000 as your liability, right? So I had that cheat sheet, which apparently made me a dream client, which is kind of awesome. And then so after my talks with them, they said to me, okay, I'll get back to you with my 3 top recommendations for a product for you. Great. Waited for the email to come through. All the emails came through and I thought, okay, so they must, if they're all working kind of like with the same banks, with the same knowledge, my situation have not changed with each of the mortgage brokerage. I'm sure that between them, there'll be a commonality of one product that stands out that I could go, yep, that's it. That's the one for me, It turns out that each of them had their top 3. So I ended up with 9 top products that I then still had to go. I narrowed down from 9 to 1. And I also did do dipped my toe into, because I just saw so many ads of how you can pay your mortgage in 10, 15 years as opposed to 35 or 40 or whatever the length might be. So I did do that. I did sit down for a couple of hours and, and listen to what it is that they had to say and how it would all work out and, things like that. And it's really nothing new except for the way that you kind of circle your money around and where you put it into accounts. And you do have to be very vigilant if you do want to do that particular, pay it off in 10, 15 years kind of thing. So that wasn't for me. So I went back to the drawing board of, picking out a product out of the 9 supposedly best products. And then, it was a matter of figuring out what is really important to me. Is it the rate? Is it the cashback? Because some of them came with cashback and some of them didn't. What are the other products that are attached to it? If I would have a mortgage offset, a credit card, redraw facility, all of those things. Because, some products would say we're offering the lowest variable rate, but there's no mortgage offset and there's no redraw facility.
Yeah.
Or some would say ours is just 1% higher, but you're getting a $4,000 cashback and a mortgage offset, right? And so it's about figuring out what is actually important to you and actually doing the math. So say, for example, a product that says our variable rate is 6.0. There's no cashback. And our product is 6.15%, but there's a $4,000 cashback. Well, what does that difference in, interest variable actually mean dollar-wise? And is it going to be covered by that cashback or not? So it's actually making all of those calculations, because when you don't, you can kind of, put it into your head, okay, so which one is actually better for me? Do I want the cashback? Do I want the lower rate? And it's different from state to state as to what is the cost of actually getting out of your current mortgage, and then also the cost of, kind of changing your insurance and changing who is going to be your mortgage holder. There's a lot of legal paperwork as well that is a fixed cost. Sometimes you have to also think about that and go, well, does your cashback cover all of those fixed costs? And some of the mortgage plans come with a one-off annual fee. Some has an ongoing annual fee. Some has a registration fee. It is a minefield, Grace. I had to do what I do as analyst and do the whole Excel sheet comparison thing to be able to actually land on a product.
And did you land on a product in the end?
I did.
You did?
I landed on a product. I will say, though, that I did take one that wasn't 5 point. I think there was one that was like 6.0 and one was 6.1. But I took the 6.1% product because it did come with the cashback. It had the mortgage redraw. It had a mortgage offset. The brokerage was going to cover my first year of annual fee subscription. So that kind of canceled out some of my cost as well. And yeah, so I did land on a particular product, but it did take me a while to figure out what other products out there, actually creating my own Excel spreadsheet of what the offers are, and then figuring out what the actual dollar differences are on a payment plan basis, on whether that extra 1% would be covered by the cashback, comparison of the annual fee, and then actually choosing a product that way. And I will give a shout out that sometimes it does depend on your gut feeling as well. When you talk to a mortgage broker or a lender or, anyone like that. And I won't lie, other than the numbers, I went by that whole gut feeling of like, yeah, I think this one actually does have my back, or like they know actually a little bit about how the financial system works and what's actually happening in the property market. One of them have actually heard of me before, so a bit of a plus. But yeah, so it was a journey for me. And to think that I am in the industry and I am a numbers gal, and if you're not, the kind of processes that you would have to go through to make sure that you have the best deals for yourself.
If you don't mind sharing, if it was going you got by $900, what did you get it down to when you did the refinancing?
Yeah, so if I had gone with my original lender, I would need to find an extra $900 somewhere, right? With this new product that I got, it meant that I had to find an extra $400 somewhere.
Okay. Way more manageable.
Definitely.
So much more manageable.
Definitely so much more manageable. And the good thing about refinancing sometimes as well is, depending on your profile, you can actually project out as to any other costs that you might have and then refinance as a package. So I knew how much loan I had left on my house, but I also know that I wanted a new car because my current one, oh my God, Grace, I think it's on its last leg. Sometimes when I'm driving, I'm crossing my fingers that I actually get there. I could project out that the new car might cost an extra however many thousand. And so I actually put that on top of the home financing loan, so that it will be that one low sort of like rate, as opposed to having two separate loans and,
paying extra on a car loan.
Yeah, paying a car loan and a house loan at the same time. So even with that added on top, I was still able to keep it to a manageable sort of like payment, which is really good. And, refinancing is, it can be scary because of the unknown of the type of products and how to handle all of those products. But when you can actually sit down and figure out, okay, so this might be my big expenses in the next 2-5 years, because I know that these days refinancing is not a once every 10 years matter. It's now once every 2-3 years sometimes. When you can sort of project out, these are some of the big costs that might be happening, whether it's a car, whether I was a little bit selfish, my 40th birthday trip, a house sort of renovation. You can kind of package it all up. And also, if you do want to pay some credit cards at the same time as well, you can package it all up. So it can be an opportunity to do all of that. Like I said, it's about having that cheat sheet ready as to what you want to do with your finances before you talk to a broker.
Yeah. And even just the fact it probably, as stressful as it was at the time, Asti, the fact that you're saving $500 a month makes that worthwhile. Like you've given the amount of time that you spent doing that a monetary value, really.
It is. It is. Like the first time I saw the 9 different options, I did sort of, put my head in my hands in despair. So now am I going to choose? But once you sort of break it down into like actual costs, actual dollar figures, it starts to make sense.
Don't go away. Plenty more from Dr. Diaswati Mardiasmo just after the break. See you soon.
Ready to supercharge your mornings while supporting work which improves the lives of Aussie heroes? This June, Invictus Australia is challenging everyone to rise at 6 a.m. and get active for 6 days by taking part in their 0600 challenge. Conquer your morning however you choose, a run, swim, or a group fitness class. Whatever gets you active and connected. Empower others to support your challenge and fundraise to help strengthen the lives of our Aussie heroes through sport and help Invictus Australia combat the statistic that we lose 6 veterans to suicide a month. So, what are you waiting for? Visit www.0600.com.au to sign up today and join the 0600 community.
Hey everyone, welcome back to this episode of Smart Property Investment Show. I am joined by Dr. Diaswati Mardiasmo, Chief Economist at PRD. Asti, it would be amiss of me to not have a conversation with you and pick your brains about what you're doing in the property space, because you've always got the coolest research about what is going on across the country. As I've said a couple of times already, you spend all day, every day, looking at data, looking at trends, looking at analysis, seeing what is going on in the market. So there is no one that I trust more with this kind of information. And I know that you've got some pretty recent research that you can share with us that is also quite interesting, especially at this point in time.
Yeah, definitely. So going off on what everyone is doing in the property market, right now, there is definitely more of a flavor on where else can we go to invest our money, or where else can we go for property investment. And the reason for that is we all know that the cost of property is just going up and up and up and up. Yes, there has been some declining growth in Sydney and Melbourne, but that has bounced back as well. Brisbane, capital city, has kept on growing. The same with Hobart, the same with Adelaide. So the research that we did was to have a look at other regional areas in New South Wales, Victoria, Tasmania, and Queensland. So what we did was we looked at the median house price in every single council in those states. So there was no council that was amiss. There was no council that we left out. And what we did was we looked at the pricing of houses in these councils. We looked at the rental yield because we wanted to make sure that it is higher than the capital city, so the relevant capital city. So, for example, the councils in Queensland that we chose has a higher rental yield than Brisbane Metro, but it is more affordable compared to Brisbane Metro, and also has a lower vacancy rate. Because obviously, as an investor, what you want is you want your high yields and you want your low vacancy rate so that your rental property is occupied quicker than ever. So we've managed to find some of them, Grace.
That is good to hear.
And this year, we've even added just a slightly different methodology because of the supply that everyone talks about. The feedback that we received was that, yeah, it's great that there might be a council out there that is more affordable, but is there actually new properties for us to buy? So we've added that element of project development, focusing on the residential supply side to ensure that, yes, there are some new developments, as in like residential developments, whether it's new houses or townhouses or units that are going into the area, but not too much, because obviously as an investor, you want to be able to purchase in the area, but you don't want it that it's so saturated that it then impacts your own, bottom line, that it impacts your vacancy rate and impacts your rental yield. So we have been able to find some. So most of these places, all of them, in fact, have a median house price of less than $600,000 as of the end of last year. We do this particular report yearly. And back in 2023, so early 2023, when we released this report, we were able to find regional areas with a median house price that was less than 500,000. So this already tells you that the property market is growing, because last year, all of the councils were under 500 to the one that we put forward. This year, we had to go up to 600,000, which does sound a lot, but still it is definitely more affordable than the capital city.
So what were then some of the areas, if you don't mind sharing? Because obviously there's so much talk around affordability and the struggle that people are going through at the moment, and that vacancy rate is just so low across the country.
Yep.
So there's obviously plenty of opportunities still out there for people who are looking at the moment.
Definitely. So if you're in Queensland, you might want to consider Mackay, Toowoomba, and Townsville. And these areas, so like I said, Mackay, Toowoomba, and Townsville, their median house price is approximately 27% lower than Brisbane, which, is quite a saving. If you're in New South Wales, Dubbo, Tamworth, and Griffith City Council was our pick, and that's about 62% less than Sydney's median house price. So definitely a big, massive saving there. For those in Victoria, our chosen ones were Ballarat, Greater Shepparton, and Wodonga. So that's about 33.9% lower than the Melbourne median house price. And in Tasmania, the City Council of Burnie, and that's about 18.9% lower than Hobart's median house price. So as you can see, like the range does, change depending on where you are at in the country. But these regional areas that we've put forward is definitely much more affordable than the capital city. And we've ensured that there are supply coming in. It does have a higher rental yield and, of course, lower vacancy rate as well.
Asti, thank you so much for sharing your insights, your wisdom, your knowledge, your own learnings in your own property investment journey. It is always a pleasure to have you on the show, and today is absolutely no exception. Thank you for taking the time, and I'm already looking forward to our next chat.
Thank you so much for having me. I hope to talk to you again soon.
To everyone who is listening along, we hope you have enjoyed this episode. Like or review us on whatever platform that you listen to your podcasts on. And if you have any questions, editor at smartpropertyinvestment.com.au. Until next time, make sure you're staying up to date with all the latest on our website, as well as social media, Facebook, LinkedIn, X, and Instagram. Stay safe and well wherever you are listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finny. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finny mortgage specialist on 02 8866 2444 or visit our website at www.finny.com.au.